Hey guys, welcome to another video diary update from me. In this session I'll be going over my investment portfolio update with the M1 Finance Roth IRA account. And as you see on the screen here, I've decided to put in some money into Roth IRA this year. The balance is up from about 9k to now 20k, and the reason is I had a change of plans. So instead of doing small investments every 2 weeks, I just decided to put in amount of money close to the limit in one go and be done with it. Here I'm showing the investment breakdown. As mentioned before, I group my investment portfolio into these sectors, starting with big boys. It's called big boys because it's made out of these 7 largest companies, also known as Magnificent 7, and I call them that because they contribute more than a third of the whole S&P 500 index. Then I have fintech and payments company, where companies like Visa are in, and we went over Visa analysis in the last week's video. Then I have tech, banks, other financials and insurance companies, food companies like Chipotle, retail, and so on. In terms of performance, you can see year to date, out of $20,000, we are down about $63, and that is nothing to be concerned about. The reason being, this is a retirement account, and we're not able to withdraw any money until I'm 60 anyways. So as a matter of fact, cheaper the better for us for the next couple of years. And we're not trying to time the market. We are trying to buy stocks gradually. So we're not worried about 5 to 10% down here and there. In this view, I'm showing the top companies making up my portfolio. You can see Microsoft and Meta are the top two companies. And that brings us into our next topic, which is doing deep dive analysis. And today I'm doing parallel analysis into these big boys, Magnificent 7 stocks, and I'll try to show you which ones look attractive out of the 7 and which ones it's preferable to be underweight. So let's get into it. I did a lot of work over the week to analyze these 7 stocks, and I'm really excited to show you the things I've done here. So the 7 stocks, to decide which ones are attractive, we try to answer these questions. Things such as if it's a solid business, if the stock is expensive, and how fast the company is growing. And finally, I'll assign a weighted average score and dollar allocation in my portfolio. First things first, we'll look at the question of capital efficiency, and for that we have 2 metrics, return on investment capital and return on equity. As mentioned before, out of the 2, I prefer the top one, return on investment capital, because return on equity can be a little bit noisy measure depending on how much debt the company has. Most of these 7 companies have very stellar return on investment capital metrics, with the exception of maybe Tesla and Amazon. Tesla is showing 5 to 10% return on investment capital, and its metrics have been struggling with the expiry of the Tesla tax credits, and also some controversy around its founders' political views. Looking at the graphs, you do see that these companies have been showing stable to growing metrics in return on investment, which justifies me assigning 10 out of 10 maximum score in this metric for all except for Amazon and Tesla. Next, we look at the profitability metric, and looking at the table and the graphs, you can see these Magnificent 7 companies show some of the best operating margin and profit margin in the stock market, I've also included the free cash flow margin at the bottom. This metric shouldn't be much different from profit margins, but it is a supplemental check just to make sure that the profits companies are showing are not just paper profits. Similar theme emerges here, which is that most of these Magnificent 7 stocks are scored 10 out of 10 for profitability, with the exception of Amazon and Tesla. Tesla receiving the lowest score once again because of going away with the federal tax credit mentioned before. Its sales is down for 2025, as well as its net income suffering. Here is a good moment to mention that Tesla is valued so high by the market at the moment, not because of its current performance, but what it hopes to achieve over the next several years. The company is trying to solve full self-driving, as well as producing these revolutionary robots, and market is giving the company benefit of the doubt. But it's up to us to discount how likely that's going to happen in the near future, and I personally discount this probability quite conservatively. Next, we look at the expensiveness of these stocks, and because they are such great businesses in terms of capital efficiency and profitability, these stocks are relatively expensive. Enterprise value to EBIT ratio for most of these companies are over 23, which is the market average, with the exception of Meta, which seems to be pretty reasonably evaluated by the market at the current levels. I've assigned scores ranging from 3, 4, 5, 8, and 10. 10 maximum score being assigned to Meta. All the other stocks appear to be very expensive at first glance. We would be doing our job only halfway if we didn't consider how expensive the stock is together with the company's growth rates. The reason being, the market isn't stupid, and it's not simply overvaluing these companies, but assuming some growth rates and factoring that into current evaluations. The case in point here is Nvidia, with its enterprise value to EBIT ratio currently 33, but the company has been growing 50 to 60% every year. And if it sustains these rates for the next 3 years, its EV to EBIT ratio would drop from 33 to 8, making this stock from expensive one into a bargain. Because of this, I redid the stock value score for these companies, factoring in the growth rates, which did improve the final score for these companies significantly. Companies like Nvidia and Microsoft now get 10 out of 10 score together with Meta and join the top of the list, being very attractive stocks. Next up, we'll quickly look at the debt levels for these companies, because we must. But do remember that these are Magnificent 7 companies, and they are all sitting on so much cash that their net debt to EBITDA ratio is actually 0 or negative. That's why they get maximum 10 out of 10 score for this criteria. Now we look at the CEO pay versus median employee pay at these companies. Because these are some of the largest publicly traded firms, you can expect their CEOs to get rewarded handsomely. And that is the fact here, with most of the compensation ranging from 50 million to 97 million. Meta pays relatively modestly to its CEO, but Zuckerberg already owns a big chunk of the firm, so he's not really waiting for his paycheck to clear. Median employee also ranges significantly. The companies where a big portion of the staff are engineers show relatively high pay rates, with Amazon being the bottom scraper here with close to minimum wage 37k pay. Tesla needs its own band because Elon Musk famously has very unique pay structure where it's all or nothing. If he hits these ambitious level of targets like automatic robots and full self-driving, he can get paid up to $1 trillion. If not, he gets paid 0. The pay ratio ranges are from 71 to 1300, while the S&P 500 average is somewhere to 185, and scores reflect that. If you've stuck with me so far, thank you. We've arrived at the finale, where I'll be putting all these scores together and assigning a final weighted average score. Magnificent 7 stocks do get relatively high scores, close to the maximum, with Nvidia, Microsoft and Meta getting the highest from the list. In the middle of the table, I'm showing how much money I would allocate if I had $100 portfolio. As you could see, I would put most of my money into Meta, followed by Nvidia and Microsoft, because their risk-reward ratios seem relatively appealing at these levels. I would invest relatively small chunks into Apple and Alphabet and Amazon, given their valuations are relatively high, and I wouldn't buy anything into Tesla, which I may come to regret, but in my opinion it does seem relatively expensive given how much progress it's made into robotics and self-driving so far. I would love to live in the future where cars drive themselves and to have a robot who cleans the house and does my grocery shopping for me, but I do think that's at least 5 to 10 years away, whereas the market is pricing Tesla like it's gonna happen in the next 2 to 3 years. Thanks for tuning in, and I'll see you next week. As a reminder, I also release some fitness related videos in this channel. Please feel free to check those out if you'd like to improve your fitness this year together with me.